Hi everybody, it's Mark here at Teslary, and Tesla closed at $266.50, which is a green day, $1.22 per share increase over yesterday's close, or 0.46%. Now this comes off the back of a pretty hot inflation report from our neighbor Canada, which really affected the yields on treasuries dramatically once the report came out, hotter than expected. We'll take a look at the report right now so we can get the news out of the way real quick. And this is just basically a summation of consensus based off actual. It's a 4.0% year over year increase, which is 0.2% higher than consensus, which is supposed to be 3.8. That's after July's also hotter print. And the month over month, of course, is going to be 0.2% over the consensus. The thing about their inflation report is their core came out 0.25% month over month. And so that's year over year, I'm sorry. And that's not so great because they're seeing kind of like an acceleration of core and headline, whereas we had a very slight month over month increase on our core inflation report, but core has been generally in line with expectations. It's just that headline is higher, which is what we also expected. Maybe not as high as it actually came out to be, but we understood that energy costs have gone up so much over the past 4 months that it makes sense. But the thing about it is, core inflation, for Canada doesn't include energy. It doesn't include food. So we're talking about shelter. We're talking about services going up in Canada. And I know Canada's not the biggest economy in the world, but, we have another inflation report in the United States coming out next Friday. We have PCE coming out. So maybe this is kind of just a sign of things to come for the US. But we've seen our economy outperform the rest of the world consistently over the past, year or so. So it could be this is just an outlier. The fact of the matter is, we did sell off pretty dramatically in the morning, but a lot of tickers recovered for slightly red days compared to what it could have been if it closed at the lows, which would have been very devastating for not really Tesla per se, but the rest of the market. Saved some mega cap names like Apple or Meta. The other bit of news that we want to check out is expectations for rate hike increases at tomorrow's FOMC meeting. We're going to take a look at FOMC price action just to kind of familiarize ourselves with how days typically proceed with FOMC, so you don't have to waste too much time or money until things kind of really matter. So here on X, this is Gergavin's kind of summation of the big banks, institutions, what they're expecting for tomorrow. So there's two institutions that expect a quarter point rate hike for tomorrow, Raymond James and Mizuho, and the rest of the names are factoring in no hikes. And a lot of these names as well believe there are no more hikes in the entirety of the cycle. We have one crazy outlier in Germany. That bank thinks we're going to get a 50 basis point rate cut. I think they just want to maybe, swing for the fences. And when it does hit one day, they'll be famous. They'll be famous for real. Now, how does this affect, how did Canada's inflation report affect our Fed funds rate future? So let's look at CME Fed Watch tool and kind of understand. No, it looks exactly the same. Basically, 98% of participants in this survey are showing that they're betting that there's no more rate hikes for tomorrow. How about the next meeting in November? It actually increased. So the no rate hike crew is actually up 5% compared to 1 day ago, which was 65%. You can see that there. And you can also see that 1 week ago, it was 55% instead of 65%. So it's possible that we are not going to get more rate hikes. And it could be just because a combination of, core inflation is kind of petering out. Headline, we all know that's really energy, mostly gasoline, actually, not just energy, mostly gasoline. So maybe the Fed is just seeing that as kind of a thing that they can't necessarily control the demand of, because it's really a supply issue with, OPEC putting the squeeze on a country like ours who doesn't want to exploit our own resources for our national security. But let's go back to the charts. We understand what's going to happen tomorrow. The only real thing that really matters in the short term is going to be FOMC, because it's not about necessarily the rate hike. Like looking at the expectations, that's great and all. You know, I understand a lot of people think there's not going to be a rate hike. We never get surprised once we kind of set the future standard on what the Fed funds rate is going to be for the next meeting, a near-term meeting. We're never surprised, okay? But everyone kind of understands Powell's outlook on things. What really matters is, you know, how the wording of the press conference speech or scripted speech is, and that's going to be 30 minutes after the release of the results of the meeting, and that's also going to be a very volatile period, and we'll show that to you when we get back to the chart. So, you know, firstly, let's look at Tesla real quick. Tesla, it kind of just flat. And why is it flat? I don't think there's any particular reason, because, you know, think of the reasons why Tesla could have been stronger than, well, we can just overlay it. We can just see it. Let's put this on SPY. We're SPY on this. So you can see for the course of the day, how Tesla performed compared to the major index. And you can see Tesla kind of outperformed it a little bit and recovered quicker and faster and higher than the S&P 500 did. But the morning was pretty volatile. So I'm going to turn off the SPY. But I want to check, I'm going to show you guys first things first is kind of the trend of how Tesla operates. So we had a quick buy in the morning. Now, these situations is that, you know, we always talk about, you know, whenever you see the first move in the morning, typically it's going to be reversed pretty dramatically. And that it was the case yet again. And in the same situation as like maybe the day before or a couple of days ago, last week, you see that quick move up and you have 1 minute, basically. This is the 1 minute time frame. You have 1 minute to capture a nice entry for a short, and you can get a nice move to the downside. It's just that, you know, catching it at the best opportune moment, it may be a little bit difficult. There would have been a 2.5% move down, but even if you kind of caught it here when it was trying to keep itself from falling with a little flagging action, just a couple of minutes after the open, you could have got a 2% move on Tesla if you would have got that short. You could have got a long as well if you can identify the long. The thing about it is we were anticipating a little bit more violent moves to the upside and downside. We were thinking somewhere in the range of getting close to like a 270, a 269. I like the $5 increments. And I was figuring that if you would have got close to 260, 261, you could probably would have gotten a long there. But it kept the move kind of constrained and mostly flattish. So unfortunately, I didn't get a good entry at all. I didn't actually enter. I wasn't really interested in getting the trade today or tomorrow. And so I think for tomorrow's action is going to maybe dictate how, if there's no Tesla news overnight or in the morning, I think Tesla will kind of respond how the rest of the market typically responds on the mornings and early afternoons of FOMC. So before we look at the price action, I want to just show you guys what we're dealing with the yields. Yields are out of control. This is a long time frame. This is 4 hour. This is 4 hour intervals in this time frame. So this is the only thing you can hope for looking at this chart. Going back to October, we've surpassed the high that was from last year. I think from a much longer term perspective, when it comes to the 10-year, we might be looking at many decades. Looking at this chart, we're interacting with 2000. We're looking basically at the great financial crisis era when it comes to yields. So we haven't had yields this high since October 2007, or essentially, yeah, I mean, we're basically almost in October of this year. So, you know, we're getting to the point where if these yields don't turn around now, it's going to get real bad. I mean, it's going to get real bad. We're going to see 5% yields, because it's really, the fact is, it's if we don't get the Fed funds rate under control, eventually the 10-year is going to get up to where that Fed funds rate is. Essentially, it's almost going to be 5% one day. If things don't really shape up better when it comes to inflation or the hot jobs market, a 5% 10-year, there's no one's going to be in stocks. Nobody. Okay, so it needs to turn around now. Now, it makes sense that the market kind of puts you in a situation where it's a turning point. The market likes to kind of get you to a point where guessing the direction is very difficult. So you can look at it like this. Let's say you're long or short treasuries. You can say to yourself, like, okay, we just peaked past the high from last year, right? So That was on top October. I guess October is always really bad because it always sells off in October, right? We talked about that yesterday. September going to October, it's pretty weak. There is usually a bottoming that's found around there. So it's not surprising that we're equal to last year's. We're actually beating last year's yield near the same month. And going back to 2007, we're at October's highs for yield. So looking at the chart, you have to say to yourself, okay, so usually when you're doing like a double bottom or a double top action, sometimes that second touch shoots over the level. Be it, if you have a double top, sometimes it just peaks a little bit above the level from the previous high, and then it sells off, right? Or if double bottom, vice versa. It's going to be, if you have a double bottom, it's not never typically a perfect bottom. It kind of shoots below it, grabs a lot of liquidity. From a double bottom perspective, it wants to kind of peak below a level, right? To do what? To scare everyone out of a trade who would have entered on that first bottom. So you have to get to the point where you're asking yourself, like, if you're long treasuries and you're at this point, you're saying to yourself, like, wait, the yield is going up past October. Do I get out now? Now this, even you could even say this is almost like a multiple touch. I mean, this is a weekly time frame, and we're seeing these yields in August and surpassing them now. But anyways, double top or double bottom, you kind of want to shoot over the level to kind of scare people out of their trade, because they have to make that decision. Like, okay, I've been swinging this for months, and I need to decide, do I want to lose more money or just get out of this trade now? I'll just set my stop loss like 1 or 2% below the last low, or in this case, the last high. And so it's a perfectly placed point when it comes to yields, because if we get a very dovish Fed and the yields come back down, it would look like, oh, it scared everyone out of their trade, right? It made everyone that was short treasuries just get out of their short, and all of a sudden it does get their short. And the people who are actually dictating this trade, pushing the envelope when it comes to scaring people out of their short, and they get the short, it's going to be great for them, right? But that's kind of how the price action needs to look like. Let's look at it from the equity perspective by just looking at the S&P 500 ETF. Let's look at this chart. Now, we've been selling for a little bit. I mean, kind of oversold on certain time frames, but not on the 15. How about an hour? What does the hour look like? We're pretty low in the RSI. We're getting this slight curl up on our MACD, but I think it's better to look at it on the daily. Daily is getting to the point where stochastic's pretty oversold, RSI is kind of in the middle, and MACD is already crossed under on the daily. So maybe not too amazing when you're looking at that. But what you can say is this: number one, the candle looks pretty decent. I mean, look at all that buying that occurred. We did a move from the intraday low to the closing price of a 0.63% move. S&P 500 status, that's actually pretty good. I mean, Tesla is going to be a little bit different because they're much more volatile. But that is a good move, and that usually is a nice sign of interest in people buying. It also could be that there was an overreaction to Canadian inflation, where Canada is, I mean, doesn't Canada have like a smaller GDP than California? I wouldn't be too surprised if that's the case. But what I did is I kind of highlighted areas on a chart for the previous FOMC meetings. So we'll look at that once I show you this. What I want to see is show you guys, really not want to see, is kind of the pattern that formed on the day. You have this kind of nice cup and handle pattern, which is a nice setup for a day that could be pretty good or pretty bad. It could just be the typical cup and handle where you have a sell off, it gets bought back up, it tests that level. You can see it tests it sells off a little bit, but not a significant low is made, and it gets back up. So you have this like a teacup pattern being formed on the day. So it's like, okay, you got this here, you got that here, there's the cup and the handle, and you're looking for a breakout. Right? Or you just have a triple top and you sell off. The thing about this is that I kind of, it's a nice pattern, and it kind of can show a bottoming process is happening. But we also know, though, is that FOMC kind of does nothing for hours a day. And let's go take a look at some or a lot of FOMC price actions just really quick to familiarize ourselves with kind of how the day might turn out. So you don't maybe have to waste your time being in a trade for too long, or you can set yourself up for a trade if it's too oversold or too overbought, and try to expect what usually happens on the release of the results of the FOMC at 2 p.m. And 30 minutes later, I believe it's 30 minutes later when the actual presser happens where Jerome Powell does his scripted speech, which is actually typically very similar meeting to meeting with very slight terminology changes. So usually that's what you're trying to analyze. You're trying to analyze like, okay, what is he saying slightly differently this time? And what you're really looking for is, what you're not going to probably get is some type of idea that rates are kind of topping out. What's most likely going to happen is he's going to address the fact that, inflation is still there. Core is not dropping fast enough. We need core to drop faster. We need to see headline inflation get back under control. Energy prices are going out of control. But like I said, there's really nothing he can do about that. That's something that can easily be manipulated against us because we're not really energy self-sufficient as what we could be if we just exploited our natural resources. We were using up a lot of the strategic petroleum reserve as well. I mean to the point where if we don't refill the strategic petroleum reserve and we're not even generating more oil, and our oil companies aren't interested in pumping out more oil, they're not interested in exploiting even the areas that they're allowed to. Not with this administration, but excuse me, but the salt caverns that hold the oil in our SPRs, they only retain their shape by the actual oil they contain. So if they don't have oil in it, and to the point where we've drawn it down, hundreds of millions of barrels of oil, if they don't get refilled in the salt caverns collapse inward. So basically, like, can you imagine a vertical hole in the ground? So some people think when it comes to the strategic petroleum reserve is that it's like oil tanks above ground and we're just keeping a bunch of oil tanks full. And whenever we need it, we just open the spigot and fill a couple barrels up with oil, send it off to a refinery. Presto, we got oil in the system. But the reality is we're not really interested in holding oil in those types of situations, because what if there's an oil spill? What if there's sabotage when it comes to that? So it's easy just to put oil into holes in the ground. So what we do is we find salt caverns that are easily accessible from the surface. They're literally like vertical holes just going deep into the ground, lined with salt. Maybe this was an old salt mine. But after being full so long, for decades, let's say, and then it start getting drained of its oil, the walls of this cavern start getting brittle and they can collapse inwards. And this is something that a lot of people that follow the energy sector are really, really worried about, just for this fact that, okay, do we just lose access to the oil if it collapses? We still have a little bit left in the strategic petroleum reserve. Where do we find new salt caverns to turn into strategic petroleum reserves if those SPRs were to collapse in on themselves? So that's going to be pretty problematic. It's going to be really bad for inflation if we don't have that at our ready to access to, tamper. Now, I'm not one to say that we need to be tapping into our strategic petroleum reserve to lower gas prices. Why don't people just buy EVs? I don't know. They don't like them for some reason. I have no idea. But so you're looking at the FOMC price action from July, and this is going to be a gap down for the morning. But if ignoring the gap down, right, it traded within a range of 0.2% for about, for hours and hours and hours, until you get to the release. It has a slight volatile move to the upside. It kind of settles back down because you can see people are actually waiting for the press conference. Press conference sends it up. Powell says something bad. It sells off, gets bought back up, and generally is a flat day for a couple of days. Then you have this gap up the next day, but that's not really anything to do with FOMC price action. So let's go to the next or previous meeting. And the previous meeting is going to be here. It's going to be in June. And you kind of have an open where it opens without a gap, but it gets bought up a little bit. So it kind of trades in a range of 0.46%. It sees a peak from that 0.46%, sells off into the release of the results of that meeting, which is right here. And it kind of has a sizable sell-off, about 0.85%. But that gets completely bought back up during the press conference, which starts 30 minutes later. And it recovers 1%, and then it sells off a little bit more into the close, 0.5%. Basically a flat day, going and into the next day, it looks bullish, just like the other meeting that we just looked at. Let's go to the next one real quick. Let's find the next one. Let's see where it's at. It's over here. Okay. This is the one in May, and you can see pretty flat price action. Again, no real gap of note. It trades within a range of 0.5%. Again, has kind of a midday dip instead of a midday peak, and then recovers that going into the release of the notes. Pretty flat, has some slight volatility up and down, and during the press conference, it sells off the entire time, basically from the intraday high to the close. It's about 1.5% down from the intraday high, or a considerable loss on the day as well. It sells off into the next day. It doesn't have that bullish move on the next day, and this looks like it's pretty flat for a long time back in May. This is just going nowhere for days. Can you imagine just trading this? That's 2 weeks that's 2 weeks where it doesn't go anywhere. God, that's brutal. Okay, let's go to the one in March. So here's March, and once again, it looks pretty flat, but let's do a measurement real quick. So here's the open. It gets bought up by 0.3%, and then it sells off towards the release of the notes. By 1 p.m., it fell 0.6%. And by the time the notes are released, it's basically flat. It's basically flat when the notes are released. It gets bought up, and it does this kind of like crazy kind of flagging, consolidation. As the press conference starts, it drops really quick. I mean, to the point where that's 0.5% within 5 minutes, but gets bought back up 1%, and then it sells off dramatically. Jesus. Like 2.5%, and gaps up the next day, and it sells off. I can't imagine if that's what's going to be like. I would say though, unless you're really good at getting the midday move, we're kind of seeing that even though the range is pretty tight during the first couple hours of the day before 2 p.m., there is a move that you can kind of continue with. It seems like that corrects itself. That's what we're kind of seeing going in. They want to be pretty flat going into the meeting around 2 o'clock. So you might see some type of small correction that will have very little resistance going to a flat move. But then it's really hard to predict the action. Typically the action is, one way on the release of the notes, and then opposite eventually when it comes to the report. But because people are really only tracking FOMC meetings since inflation started getting really hot, a lot of those reverses sometimes go to the downside. So up and down. But here's a good example of one going up, but still the pattern is pretty fixed, where it's actually Tuesday. Let's go to the Wednesday open. I'm sorry. So here's the Wednesday, and you kind of get this range of about 0.6% during the course of the day, but typically pretty flat. It might look volatile in a smaller time frame. So if you want to catch that midday move, let's say you go down, you sell off 0.5%, maybe you can get a move up and back down. Something to look for if you want to trade that to make a little bit of money, or to get in a better entry for what your ultimate thesis is going to be, trying to find those intraday peaks or lows if you're long or short. Here at 2 p.m., the release of the notes, it sells off real quick, gets bought back up, essentially wanting to go into the press conference pretty flat. And as the press conference went on, it's kind of scared people out of the trade. This is kind of a great way to scare people out. It's just simply just making a quick lower low. And we talked about this, how it works before, like in double bottoms or double tops. You just want to kind of clear the previous low or high and then do your move, because number one, you can get an entry cheaper that way. But also this move that if you would have caught it would be almost 3% towards the end of the day. And that would have been a small correction at close by about 9.9%. But so what we're seeing generally pretty flat. If you're really good at scalping, you can maybe scalp a 0.5% move here or there. It also kind of depends on the open. If it's a gap down, maybe you get a quick correction to the top side, but which sells off to the point where it was gap down to by the time the meeting happens, and then whatever move after the meeting. So if the meeting goes down, maybe it's an up move. If the release of the notes is down, it might reverse back up. Sometimes that reverse back up is just to get flat again for the meeting 30 minutes out. So the meeting is the bigger move, right? So the meeting, if if it sells off before the meeting, maybe that's your nice opportunity. Just have a cheaper long, right? I'm not saying it's going to go up, but if you see that move down, maybe you can at least get a cheaper entry. Hoping you actually make money off it. So this is the meeting from December. December was pretty volatile time. It was kind of bottoming out before the run that started in January. But looking at this, you kind of see kind of a sell-off before the meeting starts. Maybe that's good for us because we sold off a little bit, but as you can see here, it didn't really affect December's price action, unfortunately. So starting at the open, let's just say you can get a 1% move on that day and it sells off completely at the. So this is a big red candle here. This is when the notes were released at 2 p.m. It saw a drop of 2%. And like I said, it might reverse that, right? So it drops. It tries to find a base by the meeting. You can see it here. This is like this tight triangle, trying to not let the price get out of control before the meeting starts. The problem is when the meeting starts here at 2:30, it sells off really quick, but it finds some buying only to sell off again. So not great, but generally what are we seeing? Pretty flat day and a kind of violent move starting around the release of the notes. And sometimes the violent move is more towards 2:30, which would be the press conference. Here's the action from, where are we at here? November. And this is a gap down that doesn't see a gap close. So from the gap down, that the low was actually 0.8% during the course of the day. And by the time the meeting happens, like I said here, it'll try to get even with a gap. So it did try to get even where it gapped down to by the release of the notes, gets bought up, and what happens? So the move is up for the notes and down for the rest of the day for the actual press conference. So what we're seeing is one move go up and it's just reversed. If it goes down, it's sometimes reversed as well. So this is a tricky one right here. So this is going to be the one from September of last year. Now September and August and October weren't really great for the market, combined with the fact that we had the inflation prints, we had Jackson Hole, and of course FOMC. But once again, what are we seeing here? We're seeing a pretty flat day, kind of constrained to just 0.5% again. It's kind of like the thing. It's like usually 0.5%. The notes are released. It sells off considerably. And what happens after the sell-off? It reverses. And the reverse is during the course of the press conference. And you only had about 15 minutes before it starts selling up really, really hard. How do you know it's going to sell off really hard? It's really just, number one, the questions that are going to be asked by the reporters that are there, the journalists that are there covering the story. Depending on how he answers the questions, you can start seeing that if they're really poking and prodding in a certain way, number one, they have an agenda. But number two, maybe they're asking these questions because they need to be asked because Jerome Powell needs someone to ask them to get a message across. Because he wants the notes, he wants his speech to be pretty like tame or similar to each other. But that's our price action for FOMC. If you're really good at scalping, maybe you can get the move during the course of the intraday action. If you're just looking for a more easy trade, you can just try to reverse the move that happens after the press conference starts. So let's say FOMC notes come out at 2, it goes down like 0.5% and starts doing some type of flagging formation or like a triangle or a diamond, some type of pattern, which is basically saying we're trying to consolidate because we got some more news that's coming up. We want to keep the price where it's at. We can't go higher or lower really because people are really trying to sell it within a range. Like if it goes up, they're trying to get out as much as they can at a higher price, right? That's the whole point. And you can try to get them moved to the opposite side. There are plenty of examples where it's down for the notes, up going to the press conference, and down again for the actual Q&A of the press conference. So it's something you got to be really nimble for. And so think about it in reverse. It can go up on the notes. It can go down into the press conference and go back up again during the duration of the press conference Q&A. Basically, it's kind of that formation. Flat, up, down, up, or just vice versa, that flat, up, down. And sometimes it just keeps going down, yes. But you might try to find an entry, and it really is just your bias. Do you feel short? is there a reason to feel short? I mean, it's really the yields, and yields can be really telling. Like if you have your charts up, like the charts you want to go into tomorrow, you can have your S&P 500, your SPX, or whatever you want to track the overall action of the market. You can have Tesla, but you also want to have the 10-year, you want to have the 2-year. The yields might be front running the move as well. Like if you see yields keep going up during the course of the day, maybe that's a really good sign to short that, meaning that they could be priming that move for a bigger downside towards the yields, and stocks will go up in response to that. If yields and all stocks are flat, you're not going to get any read on how it's going to be perceived. It's really hard to understand. Like when it comes to the actual release of the press release at 2, institutions have AI and like computers that analyze the script and try to understand like the tonality in 0.01 seconds, and it will sell faster than you can even think to even read the whole thing or wait for it to be posted onto Twitter or something like that. The 10-year and 2-year are going to be your tools. If you're long the market, all you can really hope for that this is just a swing pattern failure, just peaking above the previous high, only to sell off and get people out of their trade. That's all you can really hope for. We can't really. I don't know how Tesla would really react to it. I can only assume that if it goes up, Tesla's going to go up even more, because a positive reaction to the FOMC meeting is really just, forecasting the end of a rate hike cycle. It's forecasting in anticipation for a near or further out Fed funds rate cut. So a rate cut is better for what? It's better for growing companies. It's great for companies who need cheap money to operate. It's good for Tesla because it affects people's ability to get a loan at a lower rate, to afford more car, to even buy a car in the first place. And how the rates will work is once the overall market has a solidified idea that rate cuts are happening in an X month period, let's say 6-month period, all these rates will start front running that, and to get competitive with each other, right? You want to get business at whatever rate you can. Like if you're a bank and you're lending out loans, and most likely you're not lending out anything. But let's say you want to offer credit because you listen to the notes. I'm sorry, you read the notes, you listened to the press conference, and the idea that you're getting from that is like, okay, they like where the economy is going. They like where rates are, the inflation is going. I need to get loans out at this percentage, as high of a percentage as I can. But the thing about it is everyone has the same idea. All the other banks, all the other lenders have the same idea, and the rates will start front running the rate cut because they might only have a couple months to kind of work with getting people a slightly higher rate than what they can get just half a year later. Do you understand? Like it's like they know people can just wait. They know it's going to happen. But the reality is, I don't think Powell will be that clear. I think Powell will be pretty unimpressed with headline inflation. I think he's still going to be slightly unimpressed with the jobs market. It's not nice that Amazon came out with that holiday hiring quota. They think they need 250,000 holiday employees for the run up into the end of the year. That's 100,000. I'm sorry, it's 100,000 more people than what analysts anticipated the holiday hiring for Amazon would be. Yeah, that's why their stock is red today, basically. Anyways, tomorrow's price action, I think there's really no way to know for Tesla. There's really no way to know. Just know that it's gonna be such an amplified move because it's so rate sensitive. Now, I just want to show you guys a chart before we end the video. And these are the 3 auto manufacturers who have workers that are currently striking their factories. Tesla is what color, guys? Tesla is the yellow one on the bottom. This is a time frame from last week till now. And we have Stellantis on top. We have GM next. We have Ford as third place. Tesla's doing awesome here at 4th place. It's down. It's being destroyed by Stellantis because Stellantis doesn't have the same type of exposure. They have a lot of different types of brands from different countries under Stellantis. It's outperforming Tesla by 5%. But we can probably look at a bigger time frame and be comforted by the fact that if we go back, oh no, Stellantis is still kicking our butt. Let's not go back, guys. Let's not go back. Stellantis is a better car company than Tesla. But in this time frame, this is great. We can just look at like this from August. We can say, oh, the thing about it though, it's like 12% more than companies that knew that they're going to have strikes against them. Sucks. It sucks. Yeah. The only other thing I want you guys should take a look at oil. Just kind of like, I know it's charting oil is stupid to a certain extent. It's getting pretty overextended though. It's getting pretty overextended. It looks like it wants to sell. From the RSI perspective, it doesn't really last that long in these really elevated RSI levels. And then when you see the levels, when you see these RSI levels kind of peak out, like what happens? The sell-off can be pretty severe. You can see these double tweezers here, a double top. This is from March of last year. And the move down when it comes to oil is 26%. Okay, when it got to that kind of oversold level. We haven't really seen that other than in the recent history. When we got into a really overbought situation, the last time was actually just a month ago. And so over the past month-ish, we're seeing a lot of interest in oil, but it is getting to the point where, yeah, I do believe it's a little bit overextended. So I wouldn't be surprised. Once again, the market's really setting it up for what? Because there was that kind of inverse correlation where oil goes up, stock goes down. Right. And if oil's really overbought, right? And then if you want to short oil, what do? You actually just long equities, right? That's the play. I mean, you can even just hedge that a little bit by you go long equities, long oil, and you just hope and that your barbell trade gets it done. But we are in that little bit overbought on the daily. Something to kind of take a look at as far as, the market, it plays the yields at basically a quadruple top for the 2-year, for the 10-year. I don't know. We're going back to 2007 on that one for the 10-year. So just there are some signs that the reversal could happen. I'm not saying it will, and I'm not saying it will, and I'm not saying Tesla would really benefit from it, because what if it's just more of like an indices thing? Like when things rally really, really hard, it doesn't necessarily mean that Tesla would take advantage of that as much as something else could, is what I'm saying. But anyways, I hope that we can have a decent day tomorrow. I really don't have like a prognosis of how Tesla can perform. What you really want to see is Tesla just give you an entry in the direction you want, meaning that if Tesla's red tomorrow and you want to go long, I mean, Wednesday options expiring on Friday are cheaper than the ones from today. And if Tesla's really green tomorrow and you think it's going to go short, I mean, that's your entry. I wouldn't really chase a move because you're already long on Tesla shares. Obviously, you're already long because you own Tesla. Going short, if you have an obvious short entry, meaning if Tesla's really green, it could be just a cheap short going into the end of the week, which is, like I said before, one of the worst weeks of the year. Thanks so much for listening, guys, and have a good night. Bye.